Welcome all to Learning Module 3 in FSA, which is Analyzing Balance Sheets. Not much in here, and what is in here is covered elsewhere anyway. So this is really just an overview module, and shouldn't take us that long at all. Let's take a look at the first LOS, which is to explain the financial reporting and disclosures related to intangible assets. Certainly an interesting area of the balance sheet, certainly something to be keenly aware of as an analyst, but we have an entire reading that's going to cover the detail later on, so we don't need to get too bogged down right here. Plus, you've seen a lot of interesting chat about software development costs if you've been through Learning Module 2 on income statements. So let's see an overview. Here's what we need. Intangible assets are, well, identifiable. You need to dwell on that for a moment. That's how the learning module starts out, telling us intangible assets are identifiable, which means they can be acquired on a standalone basis. You could buy that asset and nothing else. That raises the question of goodwill. What do we think about the identifiability, if indeed that's a word, of goodwill? Because goodwill cannot be acquired on a standalone basis. If you want a company's goodwill, you have to buy the company along with it. A customer base, okay, you can buy that. The license to use a company's brand, you can buy that separately, but you can't buy goodwill. So goodwill we'll have to look at, no pun intended, separately. Otherwise, intangibles have to be identifiable, non-monetary, and without physical substance. So we're looking at things like patents, if you will, licenses, and so on. Yes, they have physical substance. They are printed on a piece of paper, but that's not what gives you the value. The value comes from the protected revenues. And because things like patents and licenses protect your revenues over a long period of time, the patent, the license itself is an asset. It's going to generate revenues for you for a long period of time. Therefore, it sits on the balance sheet and is amortized over time. How do you recognize in IFRS land? Either cost or the revaluation model. That's in line with tangible assets. And US GAAP, only cost, no revaluation. Again, consistent with their approach to tangible assets. How long does it stay on the balance sheet for? This is interesting. Useful life may be assessed as finite, in which case we're just talking very similar approaches to tangible assets. We're going to decide on a sensible method to spread the cost of the asset over its life. Now, for tangibles, you'll see things like straight line, double declining. For intangibles, it tends to be more tailored to the asset. Something like a patent. You might look at that and say it's going to generate a lot of revenue for me, but mostly in the first couple of years. Then it'll tail off as this product loses its novelty value and then disappear. So you might say, well, I'll amortize 50% of the cost in year one. That's when I expect in year one to get 50% of the revenues. Then in year two, 25%, and then the remaining 25%, maybe you'd split over the next 5 years, something like that. But you may also assess the life as indefinite, and that's when we can throw ourselves back to goodwill. You don't buy goodwill, or take a step back from what I said earlier on, you don't buy a company with its goodwill with the aim of then gradually destroying that goodwill over the next, say, 20 years. You're trying to build it. So hopefully it will have an indefinite life. If it does, raises the question of how do we get it through the income statement if indeed we do at all? Well, let's read on. Finite lives, as I say, amortized over the useful life. Try and tailor it to the revenues it generates. Review it annually just to make sure you think that useful life is still relevant. For example, your patent still holds, your product hasn't been banned, hasn't been made obsolete by some new technology that people now prefer. And impairment as for PPE. So all the rules you see for tangible assets, which we will see later on, you'll see for intangibles as well. In other words, if the value drops below its cost, then you're going to charge the income statement. Indefinite, we said, how does it get through the income statement? Well, it does not, as a matter of course. It has no finite life, therefore, do not charge amortization. If we're trying to build goodwill, for example, over time forever, you're not losing any of its value. Don't need to reflect any of that value in the income statement. However, you must test to make sure that value has not been lost. So annual review of, first of all, the assumption that it has an indefinite life. Well, that's just the same as finite-lived intangibles. You're looking every year to make sure the life is still relevant. Here, an indefinite life. And this is where it's slightly stronger than it is for finite assets or finite-lived assets, you must test for impairment annually. With finite-lived intangibles and PPE, you look for indications of impairment and test. For indefinite, you must test annually for impairment. So that's a high-level overview of getting it into the accounts, what happens in the income statement, and how we check there's no impairments. Let's dive into a little bit more detail. As I say, we'll keep it light because we've got much more on this to come in other readings. But let's look at a little bit of detail about how we recognize these intangibles in the first place. And the basic rule is given to us here. Identifiable intangible assets are recognized on the balance sheet if they are going to generate a probable future economic benefit. My examples earlier, patents, licenses, and so on, will give you revenue, give you returns, and the cost can be measured reliably. That one is important, and that is really what leads to these distinctions. Sorry, I've gone a little bit far there. These distinctions here. Cost must be measured reliably. So you'd think for a patent, for a trademark, for a license, well, can we measure its cost? And the issue is this: if it's internally created, then that's going to be tricky. So anything like a trademark that you've spent a lot on developing internally, how do we measure what that cost us? If I go out and buy it, fine, things are a lot easier. But look at your brand name, the customer lists you built up over time, the skill of your staff, the expertise they have from all the training that you put into them. Advertising is a big one. Clearly, some huge brands on the planet generate huge revenues from the fact that they advertise so heavily. But how do you measure the cost of what you've spent? It's extremely difficult. So for internally created intangibles, most of the time, you are not going to be able to recognize because you cannot measure the cost reliably. So what we've listed out here are really the exceptions. For IFRS, research costs, seeking knowledge. Research is seeking knowledge. I had a job when I was at university, college, if you will, working in a lab, seeking knowledge, doing research. I would heat up some polymers all day long to see if they did anything good. And by good, what we really wanted them to do was to keep their fidelity in extreme heat and then be used in fireproof doors, things like that. But I heated them up for, I think, 6 weeks over one summer. And at the end of every day, they turned into a mush. I went home, heated up some more the next day. They'd turn into mush and I'd go home. Great job. Seeking knowledge, found no knowledge. That's expensed. Research, expensed. Development costs. Had I found a polymer that retained its shape, retained its fidelity at high heat, then you start to build a product, fireproof doors, something like that. Those development costs under IFRS can be capitalized if certain criteria are met. And the criteria really come back to this criteria, probable future economic benefit. Is it feasible you're going to finish it? Technologically, can you make this thing? Is it saleable? Will it make a profit? And so on. If you meet those criteria, you capitalize. US GAAP has no truck with that. US GAAP says no expense, research, and development. But they are the exceptions. Really, it's only development expenditure here under IFRS. Otherwise, because you cannot measure the cost reliably, these things are expensed. As opposed to purchased intangibles. If you buy an intangible, you can capitalize. Why? Because the cost is measurable. You can measure exactly what we paid. So you get distinctly different treatments for things like brands. You can have intangible assets on your balance sheet that say brands. This is the value of the brand. But that's because it's been purchased. So when you get a huge group like Nestle, for example, and you dive into their balance sheet and their asset base, you'll see tons and tons of intangibles and brand names as recognized assets on the balance sheet. That's because they've been purchased. Their own brand name isn't there. But you can capitalize if it arises from a contractual or legal right or can be sold separately. You buy it, you have the right to use it, you could sell it on. You have the right to use this brand name, this license, you can sell it on. You buy a customer list from somebody, you can capitalize it. You could sell that list on. Generate it yourself, the cost is not measurable, it's expensed. That's why intangibles are so interesting to study and interesting to think about as an analyst. I like to think of a company that's about to be purchased. At the moment, it's sat there with customer lists and brands and so on. Those assets don't exist. They're not recognized. They're internally generated. But the instant that company is purchased, those assets can be recognized as part of a business combination. So they suddenly spring into life. It's an accounting conundrum. How do analysts feel about this? You can see at the bottom. They're viewed with, and these are the words of the CFA Institute, not myself, they are viewed with caution for all the reasons we've just talked about. Some may exclude them to get tangible book value. So if you see a question in the exam or in life, if you're looking at a balance sheet and you think, I'm not sure of the value of these assets, to be honest, you can exclude them and just take a tangible book value. How would you do that? In the balance sheet, obviously just take those intangible assets out. That will reduce assets and reduce equity. Got to keep your balance sheet balanced, otherwise it's just a sheet. In the income statement, be aware that intangibles are being amortized and, I should say, potentially impaired. So look for impairment charges as well. So wipe out the asset, which will hit equity, wipe out the amortization and the impairment, which will affect net income. Clearly, that's going to affect a whole range of different ratios. Now, as I say, that is a high-level overview. More on that to come when we look at the long-lived assets reading. If you're excited about goodwill, well, good news. We have an LOS here on goodwill. Explain the financial reporting and disclosures related to goodwill. But once again, really, it's just an intro. Goodwill arises on the acquisition of one company by another. So for us to start delving into goodwill in depth, we would have to start looking at group accounts, consolidation, and sadly, we'll have to wait for level 2. All we need here is an overview of what it is and the entertaining issues. So it arises on the acquisition of one company by another. Internally generated goodwill is not recognized. Why? All the reasons we discussed for intangibles generally. Nestle is sat there without its own goodwill on its balance sheet. If somebody purchased the group, they would recognize goodwill. Can it be calculated is a good question, because we said to recognize intangibles, you must be able to measure cost reliably. Well, that's an interesting question. What does the accounting standard say? You calculate goodwill as the excess purchase price above fair value of identifiable assets and liabilities. There's a big exercise to do here. when an acquisition happens. The first one is to make sure you've captured every identifiable asset and liability in the target company's balance sheet. Because remember, there's going to be lots of assets in there that they have not recognized because they're internally generated. If they have a good customer list, for example, they've internally generated it, it's not on their balance sheet. But when you buy them, if you've done your due diligence, you know that customer list exists, part of the price you're paying is to get hold of that list. That's not goodwill. You have to recognize that customer list as part of the acquisition price. So when you buy them, yes, there'll be their balance sheet with all the assets they've recognized. You'll also have to make sure you put a value on all of these other assets. Secondly, once you think you've identified every asset and liability they have, you must capture their fair value. Remember, most of them on the balance sheet will be at historic cost. You cannot simply say, here's the value of net assets on the balance sheet, this is what I've paid, here's goodwill. You must find every asset and liability they have, you must restate them to fair value, and then to calculate goodwill, what is the price I paid for the business? Say 58 million. What is the fair value of all identifiable net assets that I acquired? If I'm buying the entire thing, let's say 50 million. The excess is goodwill. Now, not going into it in too much detail, but as I say, there are interesting things to consider here. Not least this fourth point. Let's just jump there for a moment. Goodwill is capitalized, so it's on the balance sheet as an intangible asset, and tested annually for impairment. As we hinted at, talked around on the last slide on intangibles, it has an indefinite life and is not amortized. There is no amortization. So assuming there's no impairment, because there's no amortization, there is no hit to the income statement. Okay, it's logical. I get that. But imagine you get into a bidding war for a company. You look at the price you think you want to pay. Maybe it was 58 million, but there's a bidding war. You're desperate to get hold of this business, so you pay 63. We've all been there after a few too many drinks one night on eBay and woken up next morning to find we paid a ridiculous amount of money for some absolute rubbish that we just didn't want. What happens? Well, the more you pay, the higher your goodwill figure is. The downside, from an analyst point of view, none of that excess cost that you've just paid is hitting the income statement. So that's a concern. The only redeeming feature of that is, well, if I have massively overpaid, there's a good chance that goodwill is going to be impaired. So we'll review the income statement, and often impairment of goodwill is a good sign that management is massively overpaying for acquisitions. Well, that's the calculation. Let's move on. What is goodwill? It's the value not recognized on the balance sheet, reputation, staff skills, etc. Intangible assets that have not been recorded, for example, research. And the reason you might be willing to pay much more than any other company is for some strategic reason. Maybe this opens up a region that you need a presence in. That makes it much more valuable to you than somebody else who's already got a presence in that region. Maybe they have a process, a machine, a factory that will save you costs in the future. The PV of those costs is part of goodwill. It is, as we said, capitalized, tested annually for impairment, so no amortization. How do we feel as analysts? Again, suspicious. What adjustments would we make if you were suspicious of goodwill? Get rid of it. Just like intangibles, remove from the balance sheet. That will affect your total assets and your equity. In the income statement, no amortization to worry about like intangibles, but you would exclude any impairment charges. That's all we need to say on the world of goodwill. Next up, explain the financial reporting and disclosures related to financial instruments. This is where we're going to spend most of the time in this learning module. All of our long-lived assets, all of our liabilities, we've got separate readings on, and you've seen some in the pre-read as well. Financial instruments are just here. So we will need to look at how to report, how to treat financial instruments in this module. So here we go. Financial instruments definition: a contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another. The focus in this reading is on financial assets. So we're looking at the asset side of it. You could be on the liability side. You could issue a bond, for example, where you have a liability, but in the pre-reads, you've seen how to account for bonds. So we're looking at the asset side here. And specifically, there's a lot of entertainment around the measurement of these financial assets. 3 methods to look at. And before we go any further, we'll mention it on the next slide, but there is a difference between IFRS and US GAAP here, but it's only terminology. So that's why we've just started here without mentioning the 2 sets of standards and said, look, these are treatments. We've got fair value in profit and loss, fair value in other comprehensive income, and amortized cost. Both sets of standards use them. US GAAP just gives them different names, which we'll see shortly. But let's see how they work to begin with. And the best instrument to focus on is just a bond. We're buying a bond. What does a bond do? It pays you coupon interest, and you'll get your principal back. So just picture that. We're buying a bond, so we're receiving a series of cash flows, and we'll get principal back. Or it could be an equity instrument. So we're just buying shares. We'll get a dividend stream. How do we treat them? First one, fair value. We might treat these as fair value, meaning in the balance sheet, we'll put them in at their fair value. Every year end, you'll measure them at their current market value. Through profit and loss, meaning any realized gains and losses go to the income statement. What do we mean by realized? Well, if it's a bond, the interest, the coupon, so this is coupon interest, sorry, mixed up my terminology. The interest goes to the income statement. If it was equity, the dividends. There's no argument there. You've got it in your hand. It's safe with you. It's in the income statement. Unrealized also go to the income statement. Unrealized are changes in market value. So each year end under a fair value method, we'll take the instrument, we'll find its current market value, restate it in the balance sheet to its new market value. If it's gone up, you'll see a gain in the income statement. If it's gone down, you will see a loss. Second method, fair value through other comprehensive income, OCI. Again, something you've met in the pre-reads or in another life somewhere. How does that work? Similar name, similar treatment. Realized gains and losses go to the income statement. Unrealized gains and losses are still recognized. So be careful, there is a key difference between those two terms. It's unrealized, it's just changes in market value. There's no guarantee you're ever going to get it because obviously the market value could, if it's risen, it could fall again. It is recognized, we put it into the accounts, but they go to OCI. So your income statement will not see the gains and losses. Why? Could just be noise. Imagine you are holding on to a 50-year bond and you're really just holding it to match cash flows on a liability that you had and you have no intention of selling it. You know, if things get bad, if I need liquidity, okay, it's there to be sold, but I intend to hold it for a long time. If that's the case, I'm not really affected by these changes in market value. So I don't want to see that noise going through my income statement. I'm unlikely to ever realize those changes in market value. Don't put it through my income statement. Tuck it away in OCI. I want to show the value because it's an important part of my asset base. If it does fall dramatically, maybe it wipes out a huge amount of assets, maybe I can no longer cover my liabilities. So you need to see its value, but I don't want the noise in the income statement. And finally, amortized cost. This is a 50-year bond, and I fully intend to hold it for 50 years. Realized gains and losses again to the income statement. Interest and dividends always go to the income statement. But on this occasion, or under this treatment, I should say, unrealized gains and losses are simply not recognized. We leave the asset on the balance sheet at amortized cost. You've seen how to account for bonds on the balance sheet in pre-reads. That's what amortized cost means using the effective interest rate method. We simply do not recognize fair value. These unrealized gains and losses are nowhere in the accounts. What does that mean? Going back to fair value through OCI, my example there, if these assets are a huge part of your asset base and are there to cover liabilities, if they start to drop dramatically in value, not only do you not see it in the income statement, you don't see it anywhere in the accounts. You have huge losses potentially on these underlying assets which are not recognized. Imagine a scenario where you're holding these long-term bonds as amortized cost. Interest rates start to rise dramatically. Once you've seen the fixed income section, you'll know as rates rise dramatically, value of those bonds will fall, big losses. Imagine you're a bank. Those assets are no longer enough, or people worry they're no longer high enough, valuable enough to cover liabilities. People panic. There's a run on the bank. Before you know it, you've collapsed. Now, recording this in 2023, a couple of months after the Silicon Valley Bank, what shall I call it? Debacle, scandal, collapse, which pretty much revolves around this kind of idea. For those of you in Mark's Applied series, or even if you're just on his YouTube channel, go and have a look at his, I think the video is In Defense of Held to Maturity, talks about exactly this issue. So what do we need? Those three different methods. Compare and contrast. That's what we're interested in for the exam. And it's, as I say, interesting background, real life implications. But for us, let's make sure we realize, no pun intended, where your interest and dividends go, where your changes in market value go, if at all. Secondly, we need to know the rules. When can we use each of these three different treatments? And here we'll introduce the different terminology that US GAAP uses. Under IFRS, we said amortized cost method was the one where we hold it on the balance sheet. We do not recognize unrealized gains and losses, not in the income statement, not in OCI. If you are going to use amortized cost method, you have to make sure cash flows are on specified dates and consist of principal and interest only. Well, they're just trying to make sure that what you're putting in as amortized cost method is debt. Your business model must be to hold the asset to maturity. You'll have to prove to the auditor that I have the ability to hold this asset until maturity. The US GAAP name for the treatment is held to maturity. What about fair value through OCI? For IFRS, debt, again, so same test here. The business model must be cash flows, but this time, your business model says I'm going to collect cash flows, but I may sell the asset. So it's on my balance sheet. I'm not saying I bought it to just sell it, but I may sell it. I can't guarantee I'm holding to maturity. And here's a little difference. I said most of the differences between the standards were terminology. Here is one difference. You can, under IFRS only, have equity as fair value through OCI. But you have to make an irrevocable election at purchase. You decide that's what you're going to do with it, fair value through OCI, and you cannot change your mind. If you do that, then you'll take any gains and losses on equity through OCI. And finally, fair value through P&L. For IFRS, if it's not in either other category, so you're not saying you're going to hold it to maturity. You're not saying your business model is to collect cash flows and sell the asset. You're saying, I've bought it to trade it, or it's equity I didn't decide it's going in here. Obviously, it can't go in there. It's going to be fair value through P&L. Or you can make an irrevocable election at purchase to put everything you want as fair value through P&L. Downside, if you do that, the noise hits the income statement. Under US GAAP, it's called trading, because if you buy debt specifically to sell it again, then it's fair value through P&L. You've bought it to sell it. The noise, the change in value you are going to realize because you intend to sell it, it should be part of net income. And for for US GAAP, all equity. All equity sits in there because there is no irrevocable election you can make to put equity as fair value through OCI. They're the rules. I said this is what we're going to focus on in this reading. There's not much more to it than that. We have the rules. We have when you can use each of them. All that remains is to see an example. And here is an example. From the underlying reading, purchase 5% semi-annual coupon bond for €100 million. I just want to add to that. At par. Don't mention that in the underlying reading, but just to make the answer absolutely right, we need to mention that. In 6 months, the fair value is €102 million. What do the balance sheets and the income statement look like for each of the three methods? So you can see our three methods here. Amortized cost, US GAAP says held to maturity, fair value through OCI, available for sale is the US term, and fair value through P&L, trading for debt is the US term. We'll need to know what the cash flows and the changes in value are. We are looking just in 6 months, what's happened. 5% semi-annual. Remember, coupons are always stated annually. So 5% semi-annual is going to be 2.5% of our 100 million. That's going to give us interest of 2.5 million. We also have a change in market value. We bought it 100 million. Its fair value is now 102. 2 million. Our concern here is how are they reflected, if at all, in the financial statements under the three methods. Let's start with amortized cost held to maturity. In the income statement, well, you always take interest to the income statement. So held to maturity, we'll see the 2.5 million. Change in market value, 2 million. Choices, income statement, OCI, so you just see it on the balance sheet, or not at all. If it's amortized cost, there's the clue in the name. It's not at fair value. You simply don't see the unrealized gains. Impact on profit and loss is just the coupon interest. In the balance sheet, 100 million is our cost. So the cost of securities, 100 million. So I'm assuming it was bought at par, so there's no amortization to worry about. Unrealized gains, no. We don't recognize the unrealized gains. What we have received is the coupon interest, so 2.5 million in cash. So impact on the balance sheet, 102,500. Nothing in liabilities, so we don't really need that heading. It's not of interest. Equity paid in capital, 100 million. Retained earnings from our net income, 2.5 million. OCI, no. And that's it. Let's compare and contrast to fair value through other comprehensive income. Available for sale, US. Interest income always goes to the income statement. Unrealized gains, it's available for sale. We will recognize the unrealized gain, but it will go to OCI. It will not go to the income statement. 2.5. Balance sheet, we receive the interest. Can't argue with that. Cost of securities was 100 million. Unrealized gain on securities, yes, we've recognized the change in market value, so we get to add the 2 million. Those two together will give you the value on the balance sheet of the debt. 104,500 in total. Equity, paid in capital again, not too interesting. Retained earnings. We only put the interest into the income statement, so 2.5 million, but we did put the extra 2 million into OCI. So 100 million and 2.5 and 2, so 104, 500. So here, just a 102, 500. And finally, trading. Interest always goes to the income statement. It's realized. It's measured at fair value through P&L, so we also see the unrealized gain. The income statement will take 4.5 million. Cash, obviously we received the interest. Cost was 100 million. Sorry, some dodgy zeros going on here. Unrealized, yes, it's in the balance sheet because we took it through the income statement. We have recognized it. 104, 500. And in equity, retained earnings, this time both realized and unrealized went through net income and hence hit retained earnings. Nothing went through OCI. There you go. Doesn't take long to get the logic of that, to repeat it, to learn it, to understand it. Don't just stare at it and say, okay, I can probably try and remember that. Look at the entertaining facts. Look for similarities, look for differences. Compare, contrast. Held to maturity and available for sale. Impact on the P&L is the same. However, one of them took the gain through OCI, one did not. So although you've got the same impact on the P&L, available for sale added the 2 million in OCI. Held to maturity did not. If you look at trading, that's the one that has the highest net income. But if you compare and contrast our total retained earnings and comprehensive income, they're the same. It's just whereabouts it went through. Was it in P&L? Was it in OCI? Next up, explain the financial reporting and disclosures related to non-current liabilities. This will take us no time at all. You've seen bond accounting in the pre-reads. We have another LOS coming up, or rather another learning module coming up on liabilities. So it's a really high-level overview. Long-term financial liabilities on the balance sheet are at amortized cost. As I say, you've seen it in the pre-reads, how to account for bonds. There are exceptions. What are those exceptions? Well, look, held for trading securities. We have just seen this. Derivatives and non-derivatives that are hedged by derivatives. So you could have, for example, let's say a Forex receivable in the balance sheet. It's just accounts receivable. It's an amount owed by your customer, but you've hedged it. You've agreed they're sending you a foreign currency, maybe you're US and they're sending you euros. You've got a forward contract to sell those euros. You've hedged it. Those two can be matched together at current market value. The idea of that, to try and match the gains and losses. It might look like the derivative is going to crystallize a huge loss, but the only reason it's there is to offset my receivable. So any loss on the derivative will be matched by a gain on the receivable and vice versa if you have perfectly hedged. All you really want to see in that case in the income statement is the mismatch, the amount that isn't hedged. Now, you may also see in non-current liabilities deferred tax liabilities resulting from temporary timing differences. You've seen some deferred tax already in the pre-read. We have an entire reading, an entire learning module on deferred tax, so we don't need to cover it again here. It's not really very efficient to go through it 3 times, pre-read here and then in the reading. Quick example, accelerated depreciation for tax purposes, straight line in the accounts, will give you a deferred tax liability. If the tax authority is allowing you to have more depreciation early on, That will reduce your taxable income, reduce the tax you pay today, increase taxes in the future. Future taxes are a liability. And that's it for liabilities. Really, all they wanted to do is make sure they'd covered every category on the balance sheet in this module, but everything we need to know in detail is covered elsewhere. So the final LOS, calculate and interpret common size balance sheets and related financial ratios. Not to sound like a broken record, but I said there wasn't too much in this reading to worry about. You've also seen common size analysis in the pre-read. We just need to have a quick look and make sure we know how a common size balance sheet works. We saw in the income statement learning module, if you've hit that already, that we'd state every line as a percentage of revenue. In the cash flow statement, you can take every line as a percentage of either revenue or outflows and inflows. In the balance sheet, every line is stated as a percentage of total assets. Now, we've got an example of a common size balance sheet in front of us. We've not been tasked with anything specific to do with it, but let's just have a look at what's going on. First of all, starting with assets, current cash, short, total current assets, goodwill. There's our total assets figure for company A, 3,250. And let's just take, for example, cash and cash equivalents. How much cash do they keep? 1,000. C keeps 3,000. As we talked about in the income statement reading, if you've seen that one, you can't just blithely say, oh, C keeps a lot more cash than A. That's kind of meaningless on its own. We need to know how much of their total assets are represented by cash. So turn this into a percentage. 1 million out of the 3,250, 30.8% of the total assets of company A are held in cash. For C, 3,000 out of 9,750, 30.8. That's remarkably similar. So we can actually say there, they've both got, around about 30%, around about a third of their total assets represented as cash. That's pretty liquid. Compare it to B, just 200 out of 3,250. Only 6.2% in cash. If they're in the same industry, I want to know what's going on. They're in different industries. There is probably a reasonable explanation. But if B is not holding on to all of that cash, whereabouts is it? Because, now I'm going to change this and put this in red to remind myself, ooh, that looks really low. What's going on? Well, it must be accounted for elsewhere. Okay, well, A obviously has some invested in short terms. C doesn't. 15 and 15 in receivables. B has a lot more in receivables. 32% as opposed to only 15. What have we got here? Inventory. A lot more in inventory. So I think there's some entertainment there to be had in analysing what's going on with B's current assets. A and C are sat on a lot of cash. Inventory is tiny for both A and C. Accounts receivable 15. Massive amounts here for B in accounts receivable and inventory. Is it just scaling up? Has it just spent a huge amount of cash building its inventory, anticipating huge demand? Maybe that demand is just starting, which is why accounts receivable are a lot higher. The bottom liabilities, shareholders' equity, what does that tell us? Well, current liabilities, nothing, basically, or equity. Look at B. 22.8 is equity, the rest liabilities. Where from? Well, it's not long term, it's total current liabilities. There's a lot going on with B's operating assets, its current assets and its current liabilities. Don't have the answers. The beauty of a common size statement, it poses questions, which you then need to go and get reasonable answers for. And finally, ratios. Which ratios can we calculate from the balance sheet? Two main sets. On the left, liquidity. We're talking there short-term obligations. On the right, solvency, long-term. Short-term, fairly straightforward. Just blast down the list. Current, quick, and cash. All three are measuring your ability to meet short-term obligations. So are my current assets high enough to pay off my current liabilities? The idea of current assets, they are liquid. you could get hold of them immediately and pay off those current liabilities, which are about to mature. But is that really true? Think inventory. Is inventory really liquid? If I had current liabilities falling due, could I use my inventory to pay them off? Maybe I'm a builder and I've got sand, and I need to take that sand and turn it into cement and use the cement to build a house and then sell the house and then collect the cash from selling the house before it's cash. So because inventory might not be that liquid, let's get rid of it. Let's remove it and calculate the acid test, the quick ratio. Cash, marketable securities, and receivables. The big one that is missing there is inventory. It's a more conservative measure of liquidity. Or we could go a step further. How liquid are your receivables? How good are you at collecting? Maybe you give 90-day credit terms and you're not good at collecting, and it takes you 100, 120 days to get that into cash. So we could remove those as well. And it would leave us with just the cash ratio. Even more conservative, just cash and marketable securities. Those you can just turn straight into cash. Will they meet my current liabilities? Now, people often mistakenly say, well, I can kind of eyeball this and say it should be above 1. Not necessarily. Different businesses operate in different ways. You may well have companies, particularly in the service industry, who don't have inventory. You'd expect to see very low ratios. Others, which have large inventory balances, manufacturers and so on, may have higher ratios. On the right, how are you financed? That's solvency. Can we meet our long-term obligations? 4 to look at. All in their own way a measure of debt versus equity. For long-term debt to equity, the clue is in the name. Just long-term on the top over equity. Debt to equity, total debt. Anything interest-bearing is total debt. So if it's interest-bearing, it should be in there. Total debt ratio as opposed to debt to equity. So make sure you know the difference between these two. They both have total debt in the numerator, but the total debt ratio is total assets on the bottom as opposed to total equity. And financial leverage. You'll see that when we get around to the world of DuPont. Total assets on the top, total equity on the bottom. How is that a measure of liabilities in any way? You might say, well, difference between equity and assets, liabilities. So you're capturing there all of your liabilities. Just an overview. Much, much more on ratios as we go through every learning module. My advice always said this in the income statement. Reading, don't learn this list. Don't write down a definition of a ratio. Practice them. Use sets of accounts. Calculate these ratios for sets of accounts. Put an Excel spreadsheet together. Play around with them. The more you calculate and manipulate, the more they'll stick in your head. That's it. Quick little reading. Most of what's in here we'll see again. Focus on the financial instruments from Learning Module 3.